Okay, we've also got Sandeep Shah, Associate Director of Motilal Oswal Private Wealth Management, joining in on the chat on this chat to talk to us about, of course, factors beyond crude that are impacting this market. Thank you so much for taking time out for us, Sandeep. Let's talk about what we saw happen today. The market coming shy of that 97.10 high, but couldn't quite hold it at the end of the session. We spent a lot of time there. Encouraging to see that after a few days of consolidation, the market's momentum is picking up pace.
Well, to put things in perspective, this particular bull market for me began in December 2011 when the Nifty was 4,500. So we've just doubled and did a little bit more, which is significantly lower than some of the other previous long-term bull markets we have in place, and which is of course my current hypothesis. We've seen markets actually go up between 7 to 10x over 5-7 years in the past. And in that sense, this has been a much safer, a more gradual bull market. And I think the long-term bull market continues to stay in place. Having said that, we've obviously rallied about 17-18% from the lows post demonetization. And I think if we see a consolidation, which in some sense is happening because the market rallies a little bit, then retreats, and then consolidates, and then maybe rallies a little further. I think that might continue for a little longer. Though I must add that if you were to look at valuations on a price to book basis, I think they are still fairly reasonable. On a PE basis, valuations can look a little higher because when you're coming off a cyclical recovery, earnings will take time to catch up. Even though last quarter we've actually seen that for our MOSL universe, both sales and PAT were at 8 or 11 quarter highs, whereas of course EBITDA growth was a little more modest. Clearly, I think that obviously we will have an impact because of GST. We are already seeing companies talking about destocking. So a quarter or maybe a quarter or max 2 earnings could get affected.
Sandeep, one of the areas which has really underperformed the market for a long time is the IT space. We all know the issues that they are plagued by. But what did you make of the NASSCOM chief's commentary today about the environment and the road ahead? There was some relief rally, temporary up move which came in around that when they gave out the 7 to 8% growth forecast for next 1 year, but it fizzled out. Do you find value there?
Well, obviously it's not a high growth number. And I think I also suspect that NASSCOM has also been a little cautious because of the environment in the US, which is the biggest market for IT companies. I think there is no, the days of high growth for the IT sector is obviously long over. I think there could be select stocks, select large cap or even mid cap stocks, which might give you about 15-20% returns, but it's not a broad brush now. I think there will be losers and winners. There will be companies that will be unable to adapt to the new environment, to automation, to digital, and the companies that succeed in making this transition, and there will be Indian companies which will succeed. I think those companies will give you reasonable returns. Don't expect very high returns, but you can expect reasonable returns. It's just that also that IT stocks have also corrected to fairly significant levels. So it's really a ground for value hunters. It's not really for growth investors in a sense, but there could still be pockets of opportunities for making reasonable returns in this environment where the high growth companies valuations are not cheap anymore.
Sandeep, for last couple of days, repeatedly we are seeing the most beaten down infrastructure names like GVK, GMR, JP Associates, hugely indebted companies, but there are reports of some initiatives being taken for debt related issues being addressed. Those are the kind of names which are seeing a lot of buying last couple of days. Do you think that area looks a merit, or it remains risky for investors and traders?
Well, I guess this is for a completely different set of investors, people with very high risk appetite, people who can actually look at investing in some of these companies and say that this is 1% of my portfolio that I'm willing to write off and buy as option value. It's really for those set of investors, but it's not something that I would frankly recommend I would recommend, because one would need to have a very strong view about how this would unravel. I agree that I think some of this going before the insolvency courts will actually ensure that managements realize that unless they act or they do something, they could lose control over their companies. And in that sense, that's a very serious and a real risk for them. And in that sense, RBI has really pushed a lot of these companies to the rope, saying that this is it for you. This is D-Day. Either you're able to come up with a very good action plan, whether it's to sell off assets or to recapitalize the business or something else which will actually revitalize growth, and they're able to actually manage their debt. A lot of these companies are actually going to see change in hands. So from that perspective, yes, this is a very interesting ground for high risk bargain hunters, but it's also a minefield. There could be companies which could actually go into liquidation as well if there is no serious proposal which comes in terms of restructuring those companies. And in case of liquidation, you could actually find that if the assets are sold off piecemeal, buildings are sold off and plants are sold off for, say, scrap value, hypothetically speaking, then there wouldn't be much value left. So there could be significant losses as well. So therefore, I reiterate that this could be a high risk, high return kind of thing, but it's a minefield. So you've got to be very careful, and only those investors who think they have the ability to analyze and have an insight into these businesses and have that risk appetite should actually consider these.
Okay. Sandeep, what are you recommending though to your clients right now? What kind of themes, should one be looking at?
For a long-term investor, there are so many high growth secular businesses in India which have compounded at 20-30% over the last decade or two, and with India actually on the cusp or undergoing a cyclical recovery, we should continue to stay invested in some of these sectors and stocks and funds which actually invest in these. And here, so continue to remain positive on private financials, NBFCs, consumer, auto. These sectors continue to show fairly high growth. Even as we had discussed last time as well, that some of the old generation private sector banks, soon hopefully some of them we will no longer call them old generation, because some of them have new generation management and they're actually using technology to actually build their business as well. So these themes remain, I think one continues to remain positive on those. While I'm not negative on PSU banks, I think that they've rallied and they need to consolidate here. And of course, though the attention remains only on the really large quality names as far as PSU banks are concerned. These companies and sectors have given growth over the last couple of decades, and I see no reason why the next decade or two we will not continue to see high growth from some of these companies.
All right, Sandeep, we'll leave it at that. Thank you so much for taking time out for us this evening and chatting with us on Smart Markets. Okay, let's take a breather here on the show, come back, and then we'll talk about Tata Power.